Hey, good morning, everybody, and welcome to the March 2023 Inner Circle Workshop, where we now have a camera that isn't going to zoom in and out every single time Matt and I move. So welcome, everybody. My name is Brad Gatto. If this is your first Inner Circle Workshop, this is Matt Stahl, my partner in crime, if you will, my co-host. We'll go co-host. Yeah. For our Inner Circle Workshops. If you were unfamiliar, Matt and I, how long have we been doing these?
Since 2020 officially.
Really? I thought we started in 2019. Is that not right?
We may have.
I think it was 2019.
Yeah.
COVID. You have COVID brain. I think we started in 2019. We've been doing these every month, and we used to do them live before COVID.
That's what I'm thinking.
Yes. I actually think that one of the best things that came out of COVID for us was the thought that, you know what, this would be a lot better over Zoom, just so that families that don't live in the Twin Cities can participate in our Inner Circle Workshops. And so it's been over Zoom ever since basically March of 2020. So Here we are in March of 2023. You believe it's been 3 years since COVID started?
It's crazy.
Nuts.
Talking about that yesterday.
But if this is your first ever Inner Circle Workshop, we're super glad that you're here. This is live, although we do record it. This time for a couple of reasons. Always for one reason, that if you want to rewatch it, you can rewatch it. This time for two reasons. One, so that you can rewatch it if you want, or send it out to a loved one you think would benefit, but also because we had a snafu in scheduling. This is normally always the last Wednesday of the month. That would be next Wednesday, not today, but because of spring breaks and things like that, we moved it up. And so there was a miscommunication with scheduling. And so I think one of our emails told you it was next week. And so that's our bad. And so we are going to rebroadcast this at the same time next week, just because I have the feeling that a week from today at this exact time, there's going to be people in here thinking, why is this workshop not going on right now? So for those of you that actually got the update and knew it was today and it worked in your calendar, thanks for being patient with us and joining us for our Inner Circle Workshop this March. This is a topic we do every year because every year taxes matter. And so before I get into the content today, which is on taxes, and I would say, Matt, the best way to describe our content for today is kind of the most common questions we've gotten on taxes over the last 12 months.
Yes.
And so again, if this is your very first one, we do these every month. They're topic rotating. And the format is a little bit of housekeeping up front, a fun and friendly quiz, as we like to call it, which just means it is a quiz, but it's not graded. And we don't know who answered what. So don't be embarrassed by not knowing answers to the questions. All we ask is for participation. Just take the quiz and do the best that you can. Because even if you get them all wrong, nobody will know, except for you. So
we do get a little bit competitive.
We do.
We like to stump you a little bit. That just means that you're learning. So don't take offense if we want you to get some of the answers wrong.
Yeah, awesome. So the other thing, the chat box is enabled. So down in the bottom part of your screen down there, if you just kind of scroll your mouse over the bottom, there should be a little chat box there for you. If you could just let me know that you can see us and hear us. Everybody say hi to us, good morning, whatever you want to put in the chat box. That way we know that our sound's on, our screen's on, and what we see is actually what you see. Good morning. Thanks for saying hi. We appreciate it. With that said, a little bit of housekeeping. I'm going to share my screen with you. Just give me a second here to do that. I'm going to get you out to the Fiat website. Let me get back to the homepage here. Everybody should be able to, hey, good morning. Thanks for saying hi, everybody. This is the Fiat webpage. If you've not hung out on our webpage, I'd encourage you to come out here. We have a lot of resources. And so I just want to update you on the resources that have come in the last 30 days since we had our last Inner Circle Workshop. So if you've never been out to the website, up here across the top are some buttons. The More button is going to bring you into the education and events that we've got going on right now. From an education perspective, I just want to point out, again, if you're unfamiliar, we do blogs all the time. And actually, since the last Inner Circle Workshop, we've had some pretty killer blogs. And so if you like to take in content on a reading basis, this is really for you. Whoops, I didn't mean to do that. But since the last Inner Circle Workshop, we've had 4, the most tax-friendly states to retire in. I'm sure some of you are interested in that. Teaser, Minnesota's not one of them. So the psychology of retirement spending, charitable giving in retirement, which is actually going to coincide with our Inner Circle workshop next month, which I'm going to talk about in just a second. And then top expenses for retirees. And so we've got the blogs out there. The other thing that's out here for you is our podcast. And so if you're unfamiliar with that, we have 2 episodes released every single month. Since the last Inner Circle workshop, we did kind of an update on the markets, which again coincided with last month's kind of Inner Circle workshop. A little bit different content and material there. So take a listen to that. And then unlocking the secrets of taxes. That I actually had a guest with me, Carly Carlson, joined me for that episode. Carly's a CPA here in the Twin Cities, which is a little bit of a teaser for all of you coming up here in just a minute. And so those are the most recent podcast episodes that have come out. And then last but not least, under the events tab is where you will find our Inner Circle workshop for next month. And so here's this month, here's today. Next month is on charitable giving, planning for generosity. And so I'd encourage all of you, the button here says click here to register. You can register for next month's Inner Circle workshop right now. You don't have to wait until next month to do that. That Inner Circle workshop, we're just going to go through tips and tricks for giving, because at the end of the day, it's really, really hard to get to the end of life and kind of bounce that last paycheck to the undertaker and kind of not have anything left to give at the end of life. And so it's kind of some end of life giving concepts, but also some giving while you're still alive, which I would argue, Matt, is way more fun anyway.
Oh yeah.
Yes. So just from a tax perspective and an overall planning perspective, how to incorporate giving and generosity into your plan. And so that's an exciting one, pretty near and dear to our hearts here at Fiat. And so that'll be a fun Inner Circle workshop next month. From a housekeeping perspective, what am I missing, Matt?
Happy hours coming up soon.
Happy hours.
It
Yes.
doesn't look like it right now.
No. Our rooftop patio, if you've actually been to our office, we've got a nice rooftop patio. I can barely see the furniture. Like I can see it now. A little bit of it has melted off, but it was a point here a couple of weeks ago where the entire patio was buried. So no, they're not starting quite yet. But come spring, which is what, June in Minnesota?
Yeah, feels like it.
We'll have the happy hours kicking back up. So yeah, great housekeeping item there. Thanks for bringing that back up. But otherwise, I think that's it of kind of what's going on here at Fiat. And so this morning, we're here to talk about kind of the most common questions we've got over the last 12 months as it relates to taxes.
Yep.
And we actually have a guest with us. Carly, could you please join us? There's Miss Carly. Good morning.
Hi, good morning, everyone.
It's good to see you, Carly. Carly Carlson actually joined us on that episode for the podcast. Carly is a CPA here in the Twin Cities, works with a lot of the families that we work here at Fiat, and quite frankly is a really important resource for Matt and I and the whole Fiat team, because at the end of the day, we do a lot of tax planning, but we don't spend our days inside of the tax code like Carly does. And so pretty valuable resource. And so we thought if we're going to be talking about taxes, we better have the expert here to back us up to make sure that we don't say anything that we're not supposed to say.
She's gonna correct all of our answers as we go through. So we get the CPA stamp of approval on all of our content today.
Yeah.
So it's gonna be a lot of fun.
Awesome. Well, Carly, thank you for being here. Number one. Number two, you're very bright today. I like it.
Spring. She's ready for
Thanks.
spring.
Yeah.
Yeah, I've got curtains pulled back and we're pretending like it's way warmer outside than it actually is. So
It's been a heck of a winter. So let's talk about something positive, taxes. let's not talk about the weather. So what I'm going to do is I'm going to bring up the fun and friendly quiz. I actually think we got this right. Last month was a struggle, if we're just being honest.
Yes.
The camera was a little bit of a struggle. The quiz didn't work the way that it normally does.
We had to pivot.
So far we're 1 for 1. Like we got the camera right. Now we're going to figure out if we're 2 for 2.
You're gonna jinx us.
I know.
I do have
Gosh.
one more order of business before we get started. So I do have a dad joke.
Oh yeah.
Yes.
Our monthly dad joke. Okay, Matt, go ahead.
Right.
Tell your dad.
Ready? Drum roll. Why are elevator jokes always so classic and so good?
Ask Carly because you asked me already.
Carly?
why are you putting me on the spot? I don't qualify.
Yeah.
I don't qualify for the dad jokes. Why are they always so classy and so good? I don't know.
Because they work on many levels.
Oh, look at that.
And there it
There's
is.
a groan.
The right? Oh, we did get a groan in the chat box. I love it. All right. All right, we're gonna shut off our cameras and our sound just so we're not distracting during the quiz. We give you about 5 minutes to take the quiz, and so do the best that you can. Just participate. We don't care if you get the answers right or not. It just is a fun way to go through the content rather than just talking at you for the next 50 minutes. And so with that being said, I'm gonna pull the quiz up. You've got about 5 minutes, and we'll see you back here. All right, most of the answers are coming in. We got about 1 minute remaining, about 1 minute. All right, we are coming to the end here. I'm going to end the poll. 5, 4, 3, 2. Perfect. Most of you got all your answers in. Nice work. Nice work. All right, Matt, you're going to start us off with the first question. Our poll worked. I did get a question in the chat box while the poll was going on. I just want to answer that very quickly. Will there be a replay of this? Yes, there will be. So if you want the recording, we are recording this. And so if you have to leave early or something like that and need or want access to the remaining content, we can get it to you. So absolutely. All right, Matt, are you ready?
I am ready. All right. So how we're going to go through this, we are going to review the question. We will give the answer, and then Carly is going to expound on anything that she thinks that we missed. Does that sound like a plan? All right.
You got to unmute yourself though, if you're going to expound.
All right. Question number 1.
There you go.
Question number 1. If you had completed a Roth conversion in 2022, you would have access to take distributions from that Roth IRA in 2023. True or false? So we had 52% of you selected true, 48% of you selected false.
Here's my disclaimer. Matt wrote this question.
I really like trick questions. So we threw a real zinger at you. So
I like how you started with the trick question. It wasn't the last.
Yeah.
Just go with it.
No.
Number 1.
We wanted to get everyone. Yeah, we want to wake everyone up. So I really like the trick questions because there's many layers going on in this. The answer is it depends kind of, but I'd say the correct answer is true. So I'm going to give it to our audience that they did get that correct. So in this example, if I had completed a Roth conversion in 2022, say it was $40,000, and we're now in 2023, and I decided I want to take a distribution from that. Say I wanted to take a $20,000 distribution. If it's our original principal, it is not going to be taxed. However, if there is any growth above and beyond that, I do not have access to that. So in the particular for 5 years. So
From what date?
From the date of the contribution.
January 1st,
January
the year
1st,
you did the conversion. So if we did the conversion December 15th of last year, the clock, that 5-year clock on your growth starts January 1st of last year. They backdate it to the beginning of the year.
So in the corresponding years, this would not be an issue because of listen to our previous podcasts and previous workshop on how the year 2022 worked out for almost every financial market. So
yeah, you didn't have any growth.
unless you had all your money in one basket, which I hope none of you did.
Cash or energy. So Carly, anything? I've got something I'm going to share from a screen perspective, but anything you want to add to that, just kind of tips and tricks as far as these Roth IRAs and conversions and things to be cognizant of? The answer is no. That's fine.
I mean, I would just say that obviously as you're doing these conversions, I mean, hopefully you are closely looking at, the dates that conversion happened, monitoring that 5-year, and that you've got, someone on your team that's kind of helping you if you need to have access to those funds so that you're, choosing to pull from accounts, wisely, whether that needs to be maybe that is your Roth IRA and that's where those funds need to come from, but then really looking at what is taxable or not, and, what kind of earnings you have in there, where you are in that 5-year timeline. So really just working closely with your advisor as you're making those decisions.
Yeah. I actually am going to throw something in the chat box here. Y'all should have just gotten a PDF in the chat box. I sent it to everybody. Carly, can you see it?
I can.
Perfect. I'm actually going to share my screen as well. And we're going to go through this. I've put a cheat sheet in here because Roth IRAs can be very confusing because there's multiple 5-year rules. The bottom line is, typically speaking, whatever money you put into a Roth is your money. It's already been taxed. It's checking account money, or it came out of an IRA and had been taxed on the way out of the IRA and went into the Roth. So whether it's contributory Roth or it's conversion Roth IRA, your principal, the money you deposited, has already been taxed. And so in most cases, that's accessible to you like a checking account would be. But it's the growth of that money that we're going to be very careful with. And there's technically 3 different 5-year rules to abide by, whether it's a contributory Roth IRA or conversion Roth IRA. And so this is just one of those deals where I agree with what you said, Carly, like talking to you or whoever their CPA is, talking to us, and just making sure that we get this right. Because the last thing you want to do with any type of IRA is get the rules wrong. Because IRAs in general, Roth or traditional or otherwise, there's tons of rules as it relates to how to use them, whether it's while you're alive, at death, or whatever it may be. And so as you can see on the chart that I've given to every single one of you, the 5-year clock and the distribution ordering rules is what it's called. There's a lot of different things that we need to be cognizant of. Now, if you're a family that's already working with fiat, just know we're keeping track of this for you. If you've done, as an example, Roth conversions over the last 3 or 4 years, we are keeping track behind the scenes of those conversions, the amounts, the dates, and things of that nature, so that when it comes to ordering and it's time to come spend this money, we know which 5-year clocks have been satisfied. I'll give one example. As I'm going to stop sharing my screen here for a second because you all have this PDF. One of the things you should know as an example of the differences is if it's contributory Roth IRA and I open that for myself at 40 years old, my 5-year clock starts this year. And I only have to satisfy that clock one time. And so any contribution I'm making in year 6, year 7, year 8, it has no holding period for that growth relative to it being tax-free growth because I've already satisfied the 5-year clock. Whereas if it's a conversion, a Roth conversion, sounds like semantics. I hate that they're both C words because it makes it hard to remember. Contributory Roth and a conversion Roth, but they have their own 5-year clock. So every time you convert that chunk of money, if it was 40 grand this year and 40 grand last year, to use Matt's example, the 40 grand last year has a different clock than the 40 grand this year. They all have their own separate clock. I think I got it all.
I think you got it all. Lots of record keeping there.
Yes.
I think what we can take away from that is for the younger people in your life, it's a good idea to start a Roth IRA as soon as you can.
100%
to begin that clock.
100%. Yeah, in fact, I've got 2 minor children and I'm working diligently to get them earned income just so I can get them Roth IRAs opened up for this very, like, even if you just open it and have $10 in it, the clock is started. So there's really no reason not to start the clock on a contributory Roth as soon as you possibly can. And so most of you on this workshop today are retirement age, which means your kids and your grandkids should be taking advantage of opening those accounts. I mean, in most custodians these days, there's no fees to open, no fees to maintain, so like, it's not going to cost you anything just to go open a shell account just so that your clock starts. So really good advice, Matt. Nice job. Crushed it. All right. I got a question that came in. Let's see here. Doesn't necessarily relate directly to that question, but we're going to answer it right now anyway. Carly, I'm going to throw this one to you. Is it true that financial institutions are obligated to report individual transactions over $600?
Okay, there's a lot of nuance to that because it depends on the type of income, what the reporting threshold is. So for example, interest and dividends that come from your bank, that's actually a $10 reporting threshold. So anything over $10 has to get reported. When we're talking about proceeds from the sale of stock, that's $600. When we're talking about income that is earned, like contract income that would be reported on a 1099 NEC, that's $600. I think there was a lot of news over this in the last year or so with the increase of like Venmo and PayPal usage. And we talked about this a little bit on our podcast, but because we live in this voluntary tax system where we have to report to the government how much we made, the IRS wants to encourage us to do that honestly by having other people kind of tattle on us. So the banks and other institutions are required to report the income that we earned. And in the last few years, the IRS started getting worried about some of these online, like paperless money transactions that are happening via Venmo and PayPal, where potentially people aren't reporting their income that they're making and that there wasn't really a clear way to track that. So yes, potentially, yes. I would say most people who are W-2 employees don't really need to worry about this. You're splitting your bill at dinner with your friends and you pay over Venmo and that happens multiple times. Like, I'm not worried about you having some sort of reporting requirement. But if you're self-employed and you're getting paid over Venmo, you should absolutely be picking that up as income.
Yeah. Which, by the way, there's also I've gotten a couple comments that people can't see the PDF. I don't know why this is an issue. It's an issue every single time we put stuff in the chat. Most people can get it. For some odd reason, some people's chat boxes don't download those PDFs. We'll send it out to all the registrants for the workshop afterwards, because I've got another handout to give you as well. But Carly, what a great segment and commercial for that podcast. That was a super fun podcast episode so if you want to go back and listen to that, the history of, going back to them taxing us directly since 1913, but then the history of like W-2s and 1099s and this idea of how the government has found ways to check in on us and make sure that we're telling the truth. As I was doing some research and homework for today and looking at some of the, budget proposals for 2024 and beyond that Biden's administration has put out as far as taxes are concerned, the IRS estimates every year that they miss out on about $450 billion of taxes by us not telling the truth, basically. And maybe it's not telling the truth. Maybe it's just you just don't know that you're supposed to do something differently and they miss out. So we've also heard a lot of rumblings about them increasing their staff, right? And trying to staff up to try to catch us a little bit more. So, which is true, that's coming. But at the end of the day, they're not looking for perfection. I thought it was hysterical. They're hoping their high bar is to get it 90% right, like to basically find 90% of the taxes that are actually due. So that was a complete sidebar. We're going to go back to question number 2. All right. I'm still sharing this. Here we go. If you were planning to retire at the age of 56, you would have complete access to take distributions from any of the accounts except for choose one. The most popular answer was the 401k, with the traditional IRA coming in second. Over 50% of you said 401k, so nice work. That is actually the correct answer. Of all of those, actually, excuse me,
No,
it's not the correct answer. I flip-flopped in my head. Because it's a double net. Which one can you not?
I wrote that question.
Yes, Matt wrote this question. Would have complete access from all except, okay, the one you cannot is the traditional IRA. The traditional IRA. Gosh, I almost got my own question wrong. Well, it's not my question, it's your question. You guys were close. 42% of you said traditional IRA. A brokerage account, which is just, if you're unfamiliar, is an after-tax savings account, investment account rather. So this is checking account money that you chose to invest in the stock market. That's a non-retirement account. That money, because it's not a retirement account, it's not qualified, so it doesn't have all these restrictions and rules. You can put that money, put as much in as you want, pull as much out as you want. It's a savings account that's invested in the stock market for all intents and purposes. So that one you have access to. Obviously, a bank account you have access to. That's your bank account, same thing. The 401k, this is where we got you here, is 56 is the age. Traditionally, we think of these qualified accounts as age 59 and a half. That's the age by which the penalties go away and you have complete access to your funds, your pre-tax monies, and all you have to do is just pay the tax on the way out without any penalty. The exception to that is your 401k. Your 401k actually allows you, if you leave the money in your 401k and you retire and you do not move it to an IRA, you have access to that money as early as age 55. There's an exception, but it's only inside the 401k, not if that money comes out into an IRA. Now that I got it right, Carly, anything you want to add?
Well, a few things. I would say, I do think that question was tricky, but when it comes to like having access, you have access to the funds in all of those accounts. It's just, do you have access to those funds penalty free? So yep. I think that was really where that question was getting at, was where can you take money out and not have to face that penalty? And then the other thing I was going to say was that I feel like more and more often when you retire, companies are kind of forcing you to get your money out of that plan. So it's not as common anymore where I see people who fully retire and then are able to keep their money in that 401k, yeah. Like they're kind of forced to do something with it and have to roll it over into an IRA, but that's not across the board.
Yeah. Carly, what's the primary reason that employers force you out?
Administrative costs. They pay fees. They're paying fees to manage your plan assets. inside of that retirement plan, and the company pays that to administer the plan, but they also pay management fees. So you have assets under management inside that retirement account, and they're paying fees on that. So they don't want to pay fees on people who are no longer employees.
One more thing I'd like to add. So I think this question in particular it's just a good illustration of the difference between true financial planning versus managing money. So if you're working with an advisor and you've had the conversation about, I do plan to retire at the age of 57, it does require a couple additional extra steps to think through the logistics of everything, as opposed to just thinking that that's automatically the right answer.
Yeah.
So
Yes.
We actually just dealt with this with a family that's onboarding with Fiat currently. I believe it was 50. I think the husband was 56, maybe 57, and was like, well, I can't. The only reason I'm not retired, they had plenty of money. That wasn't the problem. His problem was it was all in his retirement accounts. And he's like, I don't have access to any of it. So I'm stuck until I'm 59 and a half because I've got the money. I just can't get it. And we're like, well, actually, you can retire, and had this conversation with him about 401ks versus traditional IRAs. And it was like a mind blowing thing for him. He's like, what? Nobody's told me this. And so to your point, Carly, we did have to call his employer to see if he retired, if they would allow him to keep his account there. This particular employer did. And so this guy was stoked. He's going to retire 2.5 years sooner than he thought he was going to be able to, because it wasn't about money. It was about timing of having access to funds. So perfect. Let's go to question number 3.
all right, question number 3. This is not a trick question. This is very direct numbers-based question. So the gift tax exemption for the year 2023 is option number 1 is 50,000. Option number 2 was 17,000. I should have said ABC. Option number 3 is 16,000. And option number 4 was 175,000. The correct answer was 17,000. So congratulations.
Crushed it.
Good job.
I think the score is 2-1 right now.
Matt always
You
keeps.
guys are up 2. We have 1. So the
We'll get more into this next month too, but this is we get this question a lot. So
yeah. So gift tax. I want to explain this from the perspective of a real world application of this, and I'm going to let Carly chime in on all the details that I missed. Brad usually plays that role for me. I'm going to let Carly play that role. The
Winner.
real world application of this. Fast forward. So my wife Katie and I, we're in our 40s now. Fast forward 40 years. We're 80 years old. We've been working with our advisor. We've come to the conclusion that we're likely not going to spend all of our money. Okay. So we've made plans on what we want to happen with that. And we have 4 children in that. And as part of that conversation, because as we mentioned earlier, it's a
you
lot
don't think
more
you're going to
fun.
spend all your money?
I said, imagine.
Oh, okay. I was like, man, maybe we should pay you less.
I
I think we just paid Fiat some money.
no,
I don't need all this money. We don't know what we're going to do with it. I missed the imagine part. Sorry.
imagine.
Oh man, I got all really excited there.
So in that scenario, we decide that we're not gonna be able to spend all of it. As Brad mentioned earlier, it's a lot more fun to give your money away while you're alive as opposed to after you're dead. So we come up with a plan with our advisor to decide to gift our money to our children. We have 4 children. So the gift tax exemption, number 1, as we're looking at estate taxes, there's an exemption we're working with there. When our estate is above a certain level, we're going to pay an estate tax. We can also gift to, in this example, our children. 17,000 would count for Katie and I, and say that my oldest son, Owen, was married by this point, and he had a spouse. We could give 17,000, each of us could give 17,000 to each of them. So a couple giving to a couple, we can actually take that times 4. Does that make sense?
Can move a lot of money between yourself and your kids or whomever without one dealing with just any normal tax, but also not dipping into your exemption at death before you start having to pay estate taxes.
Yep.
17, each of you and Katie gave 17, that's 34, plus to the spouse, it's another 34. You could give 68. Like husband and wife could, or spouse A, spouse B could give 68 to spouse A, spouse B for kids. Is that what you were trying to, did I get that right?
Yeah.
All right, fact check
Carly?
us, Carly.
We should
Wrong.
do this every
You did great. I mean, what I was going to say,
We're gonna bring you
is-
back in for fact checking on topics you know nothing about.
No, I actually get questions about gift taxes all the time. And the thing that I just wanted to remind everyone who's attending is that the gift and estate tax regime is completely separate from our income tax regime. So we talk a lot about income tax brackets. We've even talked about capital gains tax brackets. Well, our estate tax brackets is a completely separate tax regime and tax system, and gift taxes falls under that. So when we are talking about planning for estate taxes, you kind of alluded to this threshold that we have for where we pay estate taxes. Right now, it's really high under the Tax Cuts and Jobs Act, that it doubled our estate tax exemption. So for a married couple, it's over like $26 million. So you wouldn't pay estate taxes unless the total assets inside of your estate exceeded $26 million for a married couple. And that's at the federal level. States have their own thresholds. But so what we're talking about is people who are kind of over that threshold, the IRS knows that, like, hey, to avoid estate taxes when they die, they want to give away some of their money before they die to get themselves below that $26 million threshold. And so they set up this gifting system so that they could track the gifts that you give across your lifetime and essentially add them back to your estate at the end of your life. But there's this exemption amount where it doesn't count against that, like, lifetime gift giving. So that's the other thing about gifts giving that I think is really interesting, is it's cumulative. So when we file gift tax returns, we literally add it to every historical gift you've ever made, which is really, really fascinating. And then the other thing I would say is I would recommend that you file a gift tax return, even if you stay with under that limit. Like, it doesn't hurt to just tell the IRS, like, hey, I made that gift. It documents the gift. It doesn't go against your exemption at some point in the future for your estate taxes, but it does kind of document that that money was sent, that it was a gift. And then the final thing I will say, I get a lot of questions about how much tax do my kids have to pay when I give them money? And so as the gift recipient, you don't pay tax. Similarly, as an inheritor of an estate, you don't pay tax. So the estate itself would pay tax. Potentially the giver of the gift would pay tax, which is them, like, accelerating their estate taxes, but the recipient themselves does not pay any tax. So that's the other question that comes up a lot. People getting worried about giving those gifts, or how much money to have their kids set aside for the taxes on those gifts, and there is no tax.
Very good point. And it's interesting to think through the process of filing every year, just to kind of like have the documentation, because to keep track of it yourself, and to ever like have your estate be audited after the fact, if you've got a significant estate, or as the Tax Cuts and Job Act expires and the exclusions come down and people's whose estates weren't subject before to estate taxes, again, not talking ordinary income taxes, now are, and trying to get this all right, having that documentation can be super important. So that's a really good practical piece of advice.
Well, and even like Matt said, like, if you have a married couple giving to a married couple, and you can give, $68,000 in 2023, if you write one check for $68,000, it's really nice to file that gift tax return that kind of delineates, we each gave $17,000 to each person. That gets you to the 68, not that you gave 68, one person gave one person 68,000. So by filing a gift tax return, it does also solidify how you split that up across the couples.
Yeah. And it's not to say that you can't dip into the exclusion either, because you can use the exclusion while you're alive. If you want to give more than 68, you can. Just know that you're starting to use up some of your exclusion at death. And there are definitely times where that makes sense. We've had plenty of families where we've purposely started dipping into this exclusion for various reasons. It's just that we've got this free amount every year that doesn't tap it. And that's usually where most people stop. But again, doesn't mean you can't tap into what is currently $12.92 million on a federal level per spouse, which will revert in 2026 unless they do something different, back down to 5 million. So, anyway.
And that is, it's indexed up for inflation too. So that slowly increases each year as well.
It's funny which things in the tax code the IRS has indexed and which ones it has not. So
the one that
there's
the
a lot
one
of
that
things that would be very
me,
helpful if they indexed.
Yeah, the one that always gets me that they don't index for business clients is gifts. So if in your business you give a gift, the deductible amount of that gift is $25 per person, you can't even get like a bouquet of flowers for $25. Like, you get someone a gift now. And it's been that way since like 1973. Like that threshold has never changed for what's deductible if you give someone a gift. So
That was only 50 years ago. I don't understand the problem.
what?
That actually is a great segue into the next question, because the next question alludes to something that also has not seen any sort, the calculation has not seen any sort of indexing going on. So go ahead, Matt.
This is yours.
Oh, it is? Okay.
Yes.
Shoot. Provisional income is a calculation used to determine your tax liability on which retirement benefit. Medicare, Social Security, pensions, and annuities. For y'all, Social Security won the day at 48%. Medicare came in second. You guys win again, 3-1. You guys are up 3-1 on us. That's going to be hard to come back from with only, 5 questions remaining?
Yeah, less.
But I think we can do it. The correct answer is Social Security. You guys nailed it. And here's what I want to talk about with Social Security. When it comes to filing for Social Security, I think one of the important things to understand is there's nobody that pays taxes on 100% of their benefit. In fact, on your 1040, I wish I actually had one here earlier. If you look at the front page of your 1040, which is where you tell on yourself for all the different types of income that came in the door, line 6 is where you have to tell on yourself for Social Security. This is how much Social Security I got paid. But there's 2 line 6s. It's like 6A and 6B. 6A is how much came in the door. 6B is how much of the benefit is going to be taxed at whatever your tax rates are. And the benefit that came in the door, let's just use a round number. Let's say it was $20,000. Somewhere between 0 and 85% of that 20 grand is going to be taxed at whatever your tax rates are. And so it's really important to understand that 1, you don't pay taxes on 100% of the benefit, and 2, it is possible, depending on what your provisional income calculation is, to not pay taxes on any of it. But the provisional income calculations, Carly, again, great segue. The thresholds to stay underneath provisional income calcs to have 0% of it taxed were set in place over 3 decades ago and has also not been indexed to inflation. So for a married couple, as an example, below $32,000 of provisional income, you will not pay taxes federally on your Social Security. And then the top threshold is $44,000. But again, those thresholds were put in place over 3 decades ago. So there was a lot more people in the past, 20, 30 years ago that weren't paying any federal income tax on their Social Security. But because those thresholds have not been indexed, a lot more people today are paying taxes on their Social Security. But this throws people off. And we get this all the time. There's been a couple really big pay raises to Social Security in the last couple of years because of the cost of living adjustment associated and the CPI index that it's tied to. But we've seen families that get these big pay raises and then they get their paychecks from Social Security and they actually have less money. And they freak out and they're like, I'm supposed to be getting more money. Why am I getting less money? And it could be because of Medicare, because you had Medicare premiums kick in, because your Medicare premiums are income adjusted and it's from 2 tax years ago. So it could be your 2021 tax return affecting your 2023 Social Security and what was coming out for Medicare Part B and D. We see that. But another thing we see is a tax return where somebody was getting taxed on half their benefit and half of it was coming in tax-free. And then this year, because their provisional income calc changed, 85% of the benefits now getting taxed. And so your tax bill is just bigger. And so you're netting out less. The benefit's bigger, but you just net less because the tax bill changed. And so from a planning perspective, it's just really important to understand that how you choose to work part-time in retirement, when you choose to turn on pensions and take income from a pension or an annuity, or you choose to take distributions from brokerage accounts versus IRAs versus Roth IRAs, things like this, they don't just have an effect on the dollar that you're taking out, right? So if I choose to take $1 out of my IRA versus my Roth or out of my brokerage account, that can have a cascading effect on other parts of your 1040. One of which, and a big one is for most retirees, is Social Security, because all of those things affect your provisional income, whether it's a capital gain from a brokerage account, or it's an IRA distribution, or it's earned income or a pension distribution. all of those types of monies get calculated into your provisional income, which ultimately decides how much tax you're going to pay on Social Security. All right, Carly, fact check me. What I miss?
No, you did great. I actually was thinking, I just helped my grandma-in-law, so my husband's grandma. She just got she just this year got a letter from the IRS in the state of Minnesota because she hadn't filed returns because she was living just on Social Security. So if you only have Social Security income, you pay zero tax and you don't have a filing requirement. So she was like, her CPA years ago was like, oh, you're retired, you just have Social Security, you don't have to file. So she's never filed. Well, she cashed out an annuity 4 years ago. And just, she's also, you should know, she's immigrated here in her 20s. She's French. So she's got like language barrier. She's older. Someone told her she doesn't have to file and she just thought it didn't matter. So she just never filed return. And so she had quite the surprise as we had to file taxes, pay taxes on this annuity that she cashed out 4 years ago, pay penalties and interest and all of that because she was late on filing. So just the nuance of, you know, I think, Brad, you're wise to say, just thinking about where your money is really coming from in the year and how depending on whether that's coming from a taxable account or not, can affect the taxability of other items on your return.
Yeah.
Yeah, well, the other thing, the Roth conversion decision is part of that as well. So when we're talking about all these different moving parts, that's another big piece to pull into that. And again, just illustrates when we do one thing, it is going to affect so many other things at the same time.
Yep. Yes. All right. 11:47.
All right. So this one's gonna be very straightforward and quick. It's definitely not a trick question. The standard deduction for a married couple in 2023. The only way this would be a trick question is if you didn't actually read the full question, which I was guilty of in my younger years.
I'm guilty of now. I got it wrong 2 questions ago.
The standard deduction for a married couple in 2023. The first option was option number A, 13,850. Option number B, 20,800. Option number C, 27,700. And option D, 25,000. So congratulations. 81% of you selected the correct answer. I did actually throw in the standard deduction for single and head of household as well to try to confuse people just a bit. But the correct answer is 27,700.
He just admits to his nefarious acts. Like
they're not nefarious. Admit to them.
I admitted to the crime, so it wasn't nefarious.
It's like
it's a great
it's
defense
true
in a court
multiple
of law.
choice test taking
No, Your
strategy.
Honor, I admitted to doing it. It's fine.
So standard deduction just means I go to file a tax return without itemizing or going through all my records. Just by default, I'm going to get a deduction on my income. Everybody, if I'm married, 27,700. That's significantly changed in the Tax Cuts and Job Act. I don't even remember what it was, but it was about half of that. Yeah. Inflation adjusted would have been about half of what it is now.
So messing with, for the sake of time, to get through this quickly, messing with standard deductions versus itemizing is very different in 23, 24, and 25 than it's going to be in 2026. Again, if they do nothing and the Tax Cuts and Jobs Act expires, which it's set to expire, there's nothing in any Biden proposal to extend it yet. So planning for standard deduction, if you're over the age of 65, you get even more to deduct. If you're single, it's another $1,850 this year. If you're married, it's $1,500 per spouse. So it could be another $3,000 if both husband and wife or both spouse A, spouse B are over the age of 65. It's over $30,000 for a married couple. If you're both over the age of 65 of income, you just don't have to pay any tax on before you hit that first bucket, which is 10%. So planning for that is important. That does bleed into things like giving and how you choose, like when you choose to do things in life, because you're like, well, I'm going to hurry up and get this done before the end of the year, because like medical stuff, as an example, because you're like, I'm going to be able to write it off. But then you do all these write-offs and you realize your write-offs add up to $20,000 and you worked your butt off to get to that. And you're going to have taken the standard deduction anyway. And so it's part of a planning process that when we're working with families, especially in conjunction with people like Carly, trying to figure out more creative ways to take in write-offs. And a simple example of that would be like lumping them in
Mhm.
odd years, like trying to like be diligent every other year. And so that every other year, instead of taking 20 grand a year in write-offs, we take 40 grand every other year. So we go standard, itemized, things like that, because the standard deduction is so big. I don't know the percentages, Carly. I don't know if you do. I wouldn't expect you to, of how many people take the standard deduction today versus
Right.
pre, but it's a lot.
Yeah, my only caveat that I would add in is that each state has their own rule, and I have clients in every state. So there are some states where you can take the standard deduction for the Fed, but you can itemize for the state, and their standard deduction is way lower.
Yeah.
So it actually
point.
might be more beneficial and save you money in state taxes. So also kind of looking at both. So often I tell my clients, like, give me everything, and then we'll,
Yep.
optimize between Fed and state, which one is better. But I also agree that strategy
Great
of
point.
lumping and trying to get things higher in one year can really help you to take advantage and preserve some of your tax write-offs overall.
Wonderful. Let's do question number 6 here. As part of the most recent Biden tax reform for fiscal year 24, the proposed plan would create approximately how much tax revenue to the U.S. government over the next decade? Matt, it's 5-1. They've gotten 5 right. 58% of you said $4.7 trillion.
They looked it up.
Now, I don't know if I believe that number, but that's what they say is $4.7 trillion. You guys, there's a lot in that. There's a lot in that. The majority of that 4.7 trillion is coming from the corporate side. More than 50% of that is coming from the corporate side. And then the stuff that is hitting on the personal side, most of it, the narrative is it's mostly taxes on the rich. And most of that's true. It's not completely true. But there are some things in there to watch. And so really the only reason we wanted to put that in there is because we get this question all the time. What's coming down the pipe? What is being proposed? Should I be doing anything different? And Carly, I'll let you add to this too. But I guess from my perspective, what I would tell you is there's nothing in the 2024 proposal that I think anybody needs to be super like eyes popping, like, oh my gosh, we need to hurry up and make some changes. But what's interesting to me is there is no allusion at all to extension of benefits for the Tax Cuts and Jobs Act. And that's 2024 is the year before it expires. And so there just doesn't leave a lot of wiggle room for these savings that we've gotten used to over the last handful of years being extended beyond 2025. Is there anything about this proposal or anything specific that you want to add there, Carly?
Well, I would just say, we're also coming into an election year. And so as we go into 2024 and we are facing this being an election year, I would just be really surprised that some major overhaul of the tax system happens right before we have a presidential election. And so I think it's probably more likely that we would see changes in 2025, depending on who is president. So if we have Democrats in office in 2025, we will see the Tax Cuts and Jobs Act expire. And I think if we see a change, it's more likely that we would see a move towards extending at least some of those provisions. And then I worked for a really large bank when the Tax Cuts and Jobs Act came out, and I managed like tax reform for the bank. And we expect that corporate rates are going up. So I would also foresee that in some format or another that we would expect some sort of corporate rate increase overall. But for most of our attendees, I don't think that should apply to them.
Yeah, it is interesting because the 4.7 is a gross number, and that's what they like to talk about. But there's also some massive extensions of certain benefits and credits that extend it. So that takes that away. So the number is actually more like 3.5 trillion. But then the government also plans on increasing their own budget. So the actual reduction of deficit to, even if they did all of this and got all 4.7 trillion raised, doesn't change the deficit a lot. So anyway, all right, share results. Let's go to question number 7.
Question number 7, to keep us on, I think we'll be good on time here. Question number 7 is a bit more straightforward as well. So if you're taking distributions from your IRA in retirement, when do you have to pay the tax bill of the distribution to avoid penalties?
You think this one's straightforward?
Well,
Look at the split.
Much of a tricky question.
Yeah.
Wow, it's a close one. So
Yeah.
3% of you selected A, the day of the distribution. Wow, that would be a lot. B, 29% of you selected within the calendar quarter the distribution was taken. C, 32% of you said by year end. And D, we have a bit of a typo there. way you file your taxes. When you file your taxes, D. So 35% selected that.
Despite the typo,
Despite that,
that's what they still thought was, that's the one that won the day.
the overwhelming majority selected D,
Not the
overwhelming, not the
majority.
overwhelming, the majority. Let me
was
cut
very
that
well
out.
split.
So, the correct answer is actually within the calendar quarter the distribution was taken.
We got
So
one.
We got one.
We've already lost because they already have
Yeah.
We
five.
had lost, but
But it's
There's no
5 or
coming
2.
back.
our team spirit. We had to get something going. So the if I were to take a distribution out on January 15th, the IRS ideally you're paying that as soon as possible, but technically you have until the end of that first quarter to pay the tax bill on that.
And Carly, I'm going to let you just jump right in on this one, because at the end of the day, it's when you're W-2'd in your working years, it's just super simple, because every time you pay taxes are just withheld. It's just an automated system.
Mhm.
But really what we're trying to get at here is when you retire, the onus is kind of on you to figure out how and when to pay taxes and the cadence and how much and just all this stuff. It's just kind of hard to know. And so give us a couple good rules of thumb to think about as we're trying to figure out taxes in retirement.
Yes. So the key to that question was asking about how or when do you have to have your withholding so that you don't pay penalties. So what we're talking about is underpayment penalties. And because the IRS wants their money throughout the year, if you're W-2, you get it taken out each paycheck. But if you're self-employed or you're retired, then you're responsible for paying that money in quarterly. So you don't have to pay it in as soon as you receive your money. That was one of the answers to the question, was the day you get your check, you have to pay it in. So you don't have to do it as fast as that, which is what happens when you're a W-2 employee, but you do have to do it each quarter. And the amount that you pay in starts to get tricky because it actually depends on a variable between last year's income and your current year income. But in general, the IRS is saying, hey, you owed $10,000 in taxes last year. This year, we're expecting that you're also going to owe $10,000. They always assume your income is going to stay the same or go up, never go the other way. So you should pay in $2,500 per quarter. That's kind of in general. But as we're in retirement and we start taking like lump sum distributions where you might have one quarter where all your income comes in that one quarter, and then you live off that money throughout the year, that then changes kind of when you take your distributions. So if you took a distribution in December, you wouldn't have needed to make those $2,500 per quarter payments. You could have just made your full $10,000 estimate in fourth quarter instead. And that you have to kind of know that rule, and you have to know to tell your accountant to apply that rule, because the default assumption that the IRS makes is that you earned your income evenly across the year. So if you'd like to apply the rule and avoid penalties by taking or making your payments in the quarter that you received the funds, then you need to kind of opt into that. And it's called annualizing your income. And it's where you actually tell the IRS quarter by quarter what your gross income was each quarter. That way you can match that up with your payments and show that you weren't late in making payments, and that it was okay for you to skip, first through third quarter's estimates and just pay in fourth quarter.
Yeah, really good point. Two things I want to pull out of that, Carly. Great explanation. Thank you. Number one, they're called estimates for a reason. People take these as gospel. It's one of the biggest mistakes. They're like, well, I owe this. I have to do. It's like, no, it's an estimate. We're just kind of estimating. And so we need to kind of build a pro forma, figure out if we're still on track. And to your point, the cash flow in retirement doesn't always look like a W-2, right? You've got lump quarters, we've got quarters, we have nothing. And so we need to be cognizant of that. But the other thing is, and this blows my mind, Carly, I get CPAs all the time that don't understand this. Where I've got families we work with that work with a non-Carly CPA, and their CPA is telling them that they, we're planning on doing a Roth conversion as an example in the fourth quarter. And they're like, well, we need to start paying for that now because we got to pay for that quarterly. And we're trying to explain to the family, like, no, it doesn't work that way. We're not doing it till the fourth quarter, so we're not going to owe that tax bill. We don't have to prepay it. We haven't even done it yet. Right. But because you said, like you said, the default setting is that they just assume that your income is going to be level throughout the year. So they're going to look at these quarterly estimates and make them level. Just important when you get to retirement to have somebody that can help you decide not only what income you need for your family, but how to most efficiently pay the IRS their share and what they want in it. So
the other thing maybe I would just add really fast is that the tax forms themselves for those retirement distributions do not show the date that distribution happened. So at the end of the year, when you get your 1099-R that shows your distribution from your retirement account, it just shows the total amount that got distributed for the year, not when that happened. So it's another reason why it's really important to communicate with your tax advisor and your financial advisor so that they know the details, because again, the assumption is then that it happened equally across the year.
Yeah, good point. All right, these last two will be quick. Question number 8. Is this you?
This is you.
Dang it, I always think it's you when it's me. The current debt to income ration. There's our third typo. In the US we're financial advisors, okay? We're not spelling people. The current debt to income ratio in the US is roughly what percent? You guys are up 6-2. You're crushing us. Interesting. The only reason I put that in there because there's not a lot of meat to this bone, frankly, other than the fact that we have a lot of debt. And historically, it's still very, very high. It's not the record. The record was 2 years ago. It actually has gone down. That's why I put it in there, because as of 2 years ago, it was 137%. The reason it's gone down is because we stopped cutting COVID checks. Not all of them, but a lot of them. And so the debt to income has gone down. And a little bit of income has gone up from we've actually got more revenue coming in to the IRS than we did a couple of years ago as well, because the economy not only kind of screeched to a halt a couple of years ago, but then all of a sudden the spending went way up from a government level. So 122 is still not good, just so you know. We crossed the 110% threshold in November of 2020. That broke a record that had stood since 1946, right after World War II. So still a lot of debt. And so whatever proposed tax plans are coming, we would expect that those tax plans are going to be in some way, shape, or form an opportunity to try to increase revenue. Otherwise, the government's going to have to decrease spending quite a bit. So let's go to the next question right away, though, because it is 12:02.
Yep, the record high in Minnesota on this date was 70 degrees in what year? The correct answer was...
Yes, we got this one. It's 6-3. You guys crushed us. 2-1. Nice work.
It was 1945. The 70 degrees. We put that question in there because every year at this time, I always say, gosh, it was like 70 degrees at this time last year.
It was.
Which is not true.
It wasn't.
But it was in 1945.
It was in 1945. That was, what was it? It was 70 degrees. The highest on record in Minnesota for any day in March is like 73 degrees or something like that. Not anywhere close to that today. There's still a ton of snow on the ground. And so we were just trying to make ourselves feel a little bit better about the fact that it could happen. It could happen. It's not in the forecast right now, but it could get nice at any time and the snow could start to melt. Hope. Carly, what is our tax filing deadline this year?
April 18th.
April 18th.
Emancipation Day in Washington, D.C.
There you go.
A holiday
April 18th
that only our federal government celebrates, that has extended our deadline by 3 days.
Oh, there you go. So you get an extra 3 days. If you've not yet done your taxes or you have questions on your taxes, not only are we here to help, if you're a family that we work with here at Fiat, but also, Carly, how can people get a hold of you? If they're people that don't have a CPA looking for a new CPA, how can they get in touch with you?
I'm going to actually put my website and my email address in the chat so that you guys have it. And that's the easiest, and you don't have to try to transcribe it.
Awesome. The other thing we'll do as a resource is the Roth IRA 5-year kind of clock piece that I put up. I have another 2023 year-end tax planning checklist for you. I know it's March and you're just getting your 2022 done, but it's not too early to start thinking about a checklist of what you need to get done for this year. So those two things, as well as, I know Carly's putting it in the chat, but I will also have Carly's contact information in there. At the end of the day, it's not important to just file your taxes. It's important to plan and then file, and having a CPA that understands that. And so we've joked around a couple of times about situations where CPAs don't really understand certain nuances of the tax code. And it's hard. There's 77,000 pages. But at the end of the day, it's just important to make sure that your advisor and your CPA are on the same page. If there's anything we can do to help any of you, just let us know. Thanks for sticking with us for an extra 5 minutes. We borrowed 5 minutes of your time today. We'll give it back next time. That's not true. We won't, but I can say it. So reminder, April is all about giving. And figuring out from a giving or generosity perspective, some tips and tricks on how to do that, not only from a pure numbers perspective, but how to get comfortable with it. Because one of the hardest things about giving is the idea, the fear that if you give it away, and then what if you need it? And so how do you plan in a more meaningful way to know that you can give that money away and it's not going to come back to bite you? So we're looking forward to that one. Join us in April. If you've got any other further questions, shoot us an email or that's it.
Actually, and one housekeeping item, sorry, I put my stuff in chat, but I actually can't send a chat to everyone. I can only send it to hosts and panelists. So you guys might actually have to copy and paste it for me.
Done. We'll put it in there before we log off. Everybody, I'll get Carly's info to you in the chat box in the next 10 seconds. Thanks for joining, everybody. Enjoy the rest of your day. And hopefully this day is a Saturday for you, not a Wednesday. All right. See you guys.
Thank you.